Any question, guys?
No here.
Yeah is the question or no question? Let me check. Sorry. Okay. Can you see my PPT?
Yes, Prof.
Okay. Yeah. I quickly go through the concept about provided by chapter 10. Let me check. Okay, so chapter 10 is the about the credit analysis and the distress the prediction. Okay, so relative to our discussion in chapter 10, we will provide some discussions about the likelihood of financial distress. We know is really important aspect of firm risk, right? Reminding our several weeks learnings, we talk about the firm risk, just focus mainly on the system risk, market risk. Okay, so here this kind of risk is specialized. Okay, so financial distress, the risk. Yeah, so this kind of risk also system risk. Yeah, it isolate in CAPM, capital asset pricing model. There is only one risk. Okay, that is the market risk. But here, isolate the market risk provided by the CAPM. Okay, independently the risk, and you have to give more compensation to investors. Okay, and not the same by the CAPM. The CAPM just ask corporate to give the risk premium of the market risk, not cover the financial distress risk. Okay, so here, so financial distress, the risk is very important. Yeah, in asset pricing. All right. Okay. So next, numerous parties are interested in credit worthiness of company. So we know, so like the banks, investors, suppliers, auditors, and employees, or bankers, also just related to the people, to the company. So you have a more considerations about their thinkings. Okay. So next, and next we know the debt is an important source of financing. That means you need the fundings to support your good projects. You raise the funds not only from equity markets, you also can raise the funds from debt markets or bond markets. Okay, so it's important source of financing. Yeah, and there existing some trade-offs in financing with the debt instead of the equity capital. Why we say that? Because the financing with debt, even though we have the benefits of the test shared and managers alignment, the risk, okay, the risk from the future, you have not enough money to pay your interest, you will have the financial distress, right? Okay, so why we have to more considering about the trade-off between the benefits and the cost. Okay. All right. So credit analysis is the variation of firm from the perspective of holder or the potential holder or of its debt, increasing trade payables, loans, and public debt securities. A key element of credit analysis is the prediction of likelihood a firm will face the financial distress. Credit risk of analysis is involved in a wide variety of decision content. Commercial banks, as mentioned before, ask to corporate managers, should we extend a loan to this firm because they fear that they fear that the corporates have no ability to recover loan. Okay, so if so, how should it be structured? How should it be priced? Providing that the financial distress will happen, how should it be priced to the loan? Okay. The next, if the loan is granted, the banker must later ask, are we still providing service, including credits that is furnished? Is the firm still in compliance with the loan terms? If not, is there a need to restructure the loan? And if so, how? Is the situation serious enough to call for accelerating the repayment of the loan? A potential investors ask, are the debt securities a sound investment? What is the probability that the firm will face distress and default on the debt? Does the yield provide adequate compensation for default risk involved? Investors contemplating purchase of debt securities in default ask, how likely is it that this firm can be turned around in light of the high yield on this debt in relative to the current price? Can I accept the risk and that the debts will not be repaid in full? A potential supplier asks, should I sell the products or service to this firm? The associated credit will extended only for a short period, but the amount is larger, and I should have some assurance that collection risks are manageable. Finally, there are third parties. Those other than the borrowers and the lenders who are interested in the general issue of how likely is it that a firm will avoid financial distress. An auditor asks, how likely is that this firm will survive beyond the short run in evaluating the firm's financials? Should I consider it a going concern? An actual or potential employee asks because the good employee fear that they have no job in future. So we'll ask, how confident can I be that this firm will be able to offer employment over the long term? Potential customer customer ask, because the customer feel that if they spend money on buying a company the products, have feel that in future there are no service, okay, for their product maintenance. Okay, so okay, arising from this, the potential customer ask, what assurance is there that this firm will survive to provide the warranty service, replacement parts, product updates, and other service. A competitor asks, will this firm survive the current industry shock out? What are the implications of potential financial distress at this firm for my pricing and the market share? Okay, so this chapter developed a framework to evaluate a firm's credit worthiness and assess the likelihood of financial distress. Why do firms use the debt financing? Before discussing the credit markets and the credit analysis, it is worth understanding why firms use debt financing. Debt financing is attractive to firms for two key reasons. As I mentioned before, corporate interest tax shared. In many countries, tax law provide for the corporate tax deductibility interest paid on the debt. No such corporate tax shield is available for dividend payments or return earnings. Therefore, corporate tax benefits should encourage firms with higher effective tax rates and fuel for in return earnings. Okay, so that we know the tax shares other than the interest to favor debt to financing. Okay, the firm why firms use the debt financing? Okay, as mentioned, I'm about the interest tax shared and the manager incentive alignment. Okay, so some potential downsides of debt financing. So financial distress have some of following negative consequences. Legal cost, damage to ability to raise capital, cause conflict between creditors and the stockholders. Okay, so manager incentive for value creation. Firms with relatively high leverage face pressures to generate cash flows to meet payment or interest and the principal, reducing resources available to fund unjustifiable expenses and investment that do not maximize shareholder value. Debt financing focus management on value creation, reducing conflicts of interest between the managers and the shareholders. However, in addition to these benefits debts, and there are also costs of debt financing. As a firm increases its use of debt financing, increase the likelihood of financial distress, where it is unable to meet interest or principal repayment obligations to creditors. When the firm is in serious financial distress, its owners' claims are likely to be restructured. This can take place under formal bankruptcy proceedings or out of bankruptcy, depending on the jurisdiction in which the firm operates. Financial distress has multiple negative consequences for the firm. Legal cost of financial distress. Restructurings are likely to be costly, since the parties involved have to hire lawyers, bankers, and accountants to represent their interest and to pay court costs if there are formal legal proceedings. They are often called the direct cost of financial distress. Cost of foregone investment opportunity. Distressed firms face significant challenges in raising capital as potential new investors and creditors will be very becoming embroiled in a firm's legal disputes. Thus, firms in distress are often unable to finance the investment, even though they might be profitable is the owners. Cause a conflict between creditors and shareholders when faced with the financial distress. Creditors focus on firm's ability to service its debt, while shareholders worry that their equity will revert to creditors if firms defaults. Thus, managers face increased pressure to make decisions that capitally serve, serve the interest the stakeholder and the creditors reacts by increasing the cost of borrowing for firm stakeholders. Firms are more likely to fall into financial distress if they have high business risk and their assets are easily destroyed in financial distress. For example, firms with the human capital and the brand intangible are particularly sensitive to financial distress since dissatisfied employees and customers can leave or seek alternative suppliers. In contrast, firms with tangible assets can sell their assets if they get into financial distress, providing additional security for lenders and lowering the cost of financial distress. Firms with intangible assets are therefore less likely to be highly leveraged than firms whose assets are mostly tangible. Above discussion implies firms' long-term decision on the use of debt financing reflect a trade-off between the corporate interest rate textured and the incentive benefits that against cost of financial distress. As the firm becomes more highly leveraged, the cost leverage perceptibly began to outweigh the test and the monitoring benefits of debt. On the table, okay, so table here. Okay, so this is about the median interest-bearing debt to book equity and the interest-bearing debt to market equity for selected European industry in 1995 to 2014. Market for credits, commercial banks may have a better knowledge of firm, but are constraining in the amount of risk they can assume. Non-bank financial institutions, for example, savings, loans, insurance companies, and investment bankers. Public debt markets require that firms heavily sized financial strength, credibility to bypass the banking center. Country difference in debt financing. It extends to which national bankruptcy laws protect debt providers, affects the debt financing practice. Response to the weak protection, multiple bank borrowing, supplier financing, all of the balance sheet financing, and the public debt. Okay. Analyzing the credits, and credit analysis is more narrowly focused than estimating the value of firm's equity. Business strategy, accounting, financial, and the perspective analysis are still important. The better the firm's future business prospects, the lower the risk to credit. The step a commercial lender might follow are presented next. Note that they are interdependent. Credit analysis process in private debt markets. First one, we consider the nature and purpose of loan. This helps with the structuring the depth and the duration of loan, along with the rationale for borrowing. And the next is the size the loan must be set. We still consider the debt along available security because there have numerous types of loans available from the openness of credit to this financing. The debt and the amount security needed to characterize a loan must be established. Conduct financial analysis, a comprehensive analysis of business strategy, accounting, and the financial aspects of firm. Ratio analysis is useful, particularly ratios addressing the ability to make loan payments. Assemble loan structure and debt covenants. Loan covenants specify mutual expectations, the borrower and the lender. Some covenants terms include the borrower maintaining specific financial conditions. The rating provide important information to investors. The meaning the debt ratings. Moody's have a rating system from C to AA. Standard & Poor's has rating system from D to AA. Debt ratings in first year let debt instruments must pay for investors to buy them. Okay, so the table 10.4 that's describing the debt ratings. Okay. So here. All right. So factors that drive the debt ratings. So here we provide 4 aspects of the factors. Okay. So performance measures are used to gauge the expected future healthy the firm and the ability to repay the debt. Okay, so as you see the profitability measured by return on the net capital, leverage measured by non-current debt to capitalization, profitability and the leverage by the interest coverage, cash flow to the non-current debt, fund size by revenue or the total asset. Prediction of distress and the turnaround. Models for this distress prediction. Several models to predict distress have been developed over the years. One of the more popular and robust models is ultimate z-score model. Okay, so here S1, S2, S3, S4, S5 definition is definitely written by the net working capital over total assets. S2 returned earnings over total assets. S3 EBIT total assets. S4 market value equity over the book value of total liabilities. That's one. S5 sales over total assets. Its coefficients here. So 1.2, 1.5, 1.4, 3.3, 0.6, and 1.0. Okay, so the factors drive the debt ratings can be used and multiply the find the numbers, okay, so can get this score, okay. So that distressed companies present investment opportunities because they are trying at a steep the discount. Okay, so here, so this one, okay, you can check the score. So the number is the 1.1518. Okay, so the for connection PLC, French connection PLC, for HMM, okay, here, okay, is the number, this one, okay, yeah, so check, this is our case study, yeah, so this one, okay. All right, so next, so the table shows the performance, right, gap between two companies, HMM and the French connection. Okay, HMN score demonstrates its strength. HMN has delivered steady revenue growth and abnormal profitability over the past 5 years. The book value of its liability is substantially lower than the market value of the its equity. A French connection, this score, on the other hand, highlights its relatively poor performance. In the past few years, difficult conditions in the traditional segment of apparel retail industry drove down the retailer's margins, and it reports below normal returns on equity. Further, French connections liability are almost 3 times than its market capitalization, an indication of its precarious financial state. Such models have some ability to predict the falling and the surviving firms. Ultimate reports that when the was applied to hold out the sample containing 33 Ford and 33 non-Ford firms. It correctly predict the outcome of in 63 of 66 cases. However, the performance model will degrade substantially if applied to whole out sample where the proportion fail firms was not forced to be the same as that used to estimate the model. The ultimate score model was estimated on the sample of US firms. When applying the model to the non-US firms, the following applications must be considered. First, accounting practice from country to country. In particular, under some accounting system, total liability might be understated because of firms' use of balance sheet financing. When comparing the ultimate to firms with the different accounting practice, the preferred approach will be the undoing these firm statements from accounting distortions and bring all of the balance sheet ability on the balance sheet, calculating the scores. Second, although the model might be equally useful across countries in financial distress, the likelihood balance sheet calculating the scores. Okay, so the financial distress leads to bankruptcy depends on the national laws and thus varies from the country to country. One way to overcome the above problems is to use distress prediction models. They were particular firms' home country. An international severe distress prediction model suggests that 40 variant such models exist worldwide. A common characteristic of these models is that there's some major profitability and leverage. Okay, for example, one model that was developed by T company used in UK calculates the Z scores are follow. Okay, this. There are two approaches to debt valuation. Through a prediction defaults probability and the discovery rates and the discounting expected future flows at RD. The expected rate or return on debt. So 1 minus pi 1 times the coupon 1 plus the pi 1 times the low times the face value. Pi 1 means that if there are no financial distress, it's a probability. Okay, so 1 minus pi 1, that's your that stands for your no financial distress probability. So it's expected value 1 minus pi 1 times the coupon 1. Unfortunately, if there it appear the financial distress. So with the pi 1, so you will get the face value, and the face value have to multiply by the low. Low is the recovery rate. Okay, so low time the face value, that is your residual value, your that's salvage value. Okay, so salvage value time with probability pi 1 happen the financial stress, so that's your expected value. So total expected value, that is weighted of the 1 minus pi 1 times the coupon 1 plus the pi 1 times the salvage the value. Okay, that is the low times the face value. Okay, the second the day 2 also the the financial distress with the pi 2. So 1 minus pi 2 times the coupon 2, that is your receive the coupon payment, expected receive the coupon payments from company. And if have the financial distress happened, so here use the pi 2 minus pi 1. Why we have to minus pi 1? Because suppose the pi 1 suppose at the day 1 no pi 1, so how much is it with the probability at the day 2? So you need to use the pi 2 deduct the pi 1, so that's your probability in day 2. Okay, so pi 2 minus pi 1. Okay, so by doing this, so we have t period. Okay, t period. So another approach to that variation, can you use this? The coupon 1, coupon 2, coupon t plus face value over 1 plus y, 1 plus y squared, 1 plus y power to t. Okay, this is another approach to do debt valuation. Okay, so this one, okay, this one. Okay, concluding comments. Okay, so debt financing offers tax savings and possible reduction agent costs to firms. The risk of financial distress increased with the level of debt financing. Credit analysis employs many of same tools used in business valuation and is used by issuers of debt and investors. The ratings are important information to investors of public debt. Okay, so any question, guys?
So far, so good, sir.
Yes, please. Okay. Have any question? No? All right. So today, yeah. Please, okay.
Excuse me, sir.
Yes.
I have a question. So
Yeah, sure.
about the final exam, what is the material?
Okay. So final exam, I think I will check. The firstly I will ask to finish the general homework and the discussions, and the final exam may be online. Okay, maybe online. Yeah. So maybe yeah. So I not decide to what kind of final exam provided by me. I not decide. I not yet decide. Okay. But I think it's not a difficult. I think yeah, that's okay. Hello.
Okay, sir.
Yeah. So um we have a two week 2 times um have to taught, okay, be taught, okay, so in next Wednesday and the next Wednesday, yeah, we did the 2 times, right? Okay, so let me check how is your homework, how your feedback, how your feed the discussions in trunk class. If you most students do did very well, I think our the final exam not need to give you more, maybe I just give it you the maybe 3 or 4, just very simpler questions, okay. But if I check the our trunk class, just few students finish that, and I think I will use the final exam to test you, okay, how was your performance in this class. That's okay. Okay,
Okay,
hello.
sir.
Yeah,
Thank you.
okay, thank you. All right. Okay, so chapter 11. Okay, chapter 11 is talking about the mergers and acquisition. Okay, let me check. Yeah, I will sum the I will ask a student to give us some the case study. So some examples in your country. Okay, so maybe that's your homework, or maybe we have this kind of discussions in class. So okay, so I mean the case studies. I will ask you to do that. What is the famous case study related to our the course, okay. So maybe so I use the HMM, I use the French connection, I use the budget airline like the EasyJet, Finnair. Okay, maybe in your country, have some of the famous case studies. Can one share it with us? That's okay. So I will give you a time to share that with us. Right. Okay. Okay. So this is the credit. This is the mergers and the acquisitions. Okay. So this is our chapter 11. So why have to do the motivations? We have this kind of motivations for mergers and acquisition. Okay, so many reasons, right? Okay, so but main reasons we have, there is the economy scale, improving the target management, combining complementary resources, capturing tax benefits, providing low-cost financing to targets, creating value through restructuring and breakups, penetrating new markets, increasing product market rents, and last one is diversification. Okay, so motivation to merger and the acquisition. There are a variety reasons why firms merge or acquire other firms. Some acquiring managers may want to increase their own power and prestige. Others realize business combinations provide an opportunity to create new economic value for their shareholder. Mergers or acquisitions benefits include the following. Taking advantage of economy scale. Mergers are often justified as a means of providing the two participating firms with the increased economies of scale. Economies of scale arise when a large firm can perform a function more efficiently than two smaller firms. For example, here the case, here's case, so this is the case, right? So let me check. Here's case, the Danny, let me check the case study. Shit,